Hey, accounting scholars, welcome back to section 2. Hey, we are going to start talking about a concept that you will hear over and over in your accounting life. And if you have been a student in Accounting 1, this is going to be like revisiting the homeland. But the question is, what are debits and credits? Well, kind of the interesting thing here is debits and credits are not good or bad. They're not really happy or sad. When you talk about a debit as shown on this accounting equation here on this slide, where you see an asset account and then you see a T. And again, the word T account is something you will hear over and over again. There's a debit column and there's a credit column. Same thing with liabilities. There's a debit column and a credit column, and same thing with owner's equity. There's a debit column and a credit column. And as we talked about in section 1, there is a corresponding relationship typically when when an asset account increases and that account is debited, and also the relationships on what the impact are on liability T accounts and owner's equity T accounts. But the kind of a easy way to remember this is that the debit is always on the left side and the credit is always on the right side. And even if you visualize in your mind, sitting in the classroom, I remember this was my first college accounting course, and we had a classroom very similar to the one that you're in, and the professor suggested always remember that the debits are on the left on the window side of the classroom, and the credits are on the right on the door side. So kind of keep that in mind, and make sure you've got these visuals in your notes. Again, so credits aren't good or bad. Debits are on the left, credits are on the right. Okay, so what is an account? It's actually a place in a accounting record. As we talked about, you're now in the performing phase of business activity, so you want to start setting up, call it little shoeboxes, where you're going to be placing all the various transactions that occur in your business. So this is called an account, and an account is a place where accounting records are contained, and the information pertaining to a particular asset, liability, or owner's equity account is maintained. That's what an account is. All accounts typically have a debit side, as shown here on the graphic, as well as a credit side, and are represented by a T account. So as we see, it doesn't matter if it's an asset, doesn't matter if it's a liability, doesn't matter if it's an owner's equity account. There's a T account that's present, and there's a debit side of it and a credit side of it. So here again, here's an example of a typical T account. The debit signifies the left, as in the left-hand side of the account. The credit signifies the right, as in the right-hand side of the account. The accounting equation rule, again, just to review, assets equal liabilities and owner's equity. So then assets are on the left, and as assets increase on the left side, the way to show an increase in an asset account is through a debit recording. So if you would, for instance, say cash would be an asset account. If you increase cash, that particular T account would be credited or debited. I'm sorry, would be debited as a result of that particular action. On the other hand, in the liabilities and owner's equity account, which are on the right, increases on those sides of accounts would be typically looked upon as credits. So as you increased your asset accounts and debited those accounts, there would typically be a corresponding decrease in your liabilities and owner's equity through credit recordings. Okay, so again, very important. Make sure you get this in your notes. So in an asset account, you would, as the account increases, the account would be debited. If the account is decreasing, there would be when there is a corresponding debit increase, there would be a corresponding credit decrease. Similarly, in a liability account, if there is a decrease in the account and there is a decrease, there would be a corresponding credit increase. Similarly, in a owner's equity account, if there's a debit decrease, there would be a corresponding credit increase. Similarly, if in the revenue, if you want to look at revenue and expense rules and how these are related to the particular accounts, and please get this in your note, a revenue increase, which usually translates into net income. As you know, net income belongs to owner's equity, in terms of retained earning, and it increases owner's equity. Therefore, revenues would increase on the credit side. If you look at the same thing on the expense side, if there is a decrease in net income, here again, the impact on net income is a net income belongs to the owner's equity, and increases in net income increases owner's equity. Therefore, decreases in income, which usually occurs through expenses, which reduce net income, will be an increase on the debit side. So revenue accounts, usually a decrease in revenue results in it would be a debit decrease and a credit increase. For expense accounts, if there's an increase in the expense area, there would be a corresponding credit decrease. So that, again, guys, is a mouthful and bushelful. So please take very good notes. If you make sure you understand your notes, and if you don't, please make sure that you bring these questions to class tomorrow. Have a good night, guys.